For probably 80% of the financings that I've wanted to get invested in for the last 2 years, they've been oversubscribed. The market is doing a rational thing. It's beginning to discriminate in movie parlance between the good, the bad, and the truly ugly, which is helpful. I think that corrects itself. I think we're going to go into a full-fledged precious metals bull market, and after that, a full-fledged natural resources bull market, at which point in time the investors will be just as stupid as they were 15 years ago. But for now, capital allocation is taking place, and that's the sign of a very healthy market. They jawboned this cut so much ahead of time that I think a lot of the impact of the rate cut was already factored in the market. Anybody who listened, they told you that they were going to cut rates. Consensus was 25, we got 50. So there was some follow through in equity markets, and of course, nice follow through in the gold market. Although the response was mooted because everybody knew for 3 months before what was going to happen. It's interesting to me, Lucian, that our government tells us that our economy is in such good shape. If it is in such good shape, why do we need a 50-point rate cut? So I think they said at least three things. The first thing is that the rate is political, not economic. They haven't admitted it, but their actions show it. The second thing is that they are as much concerned about the state of capital markets, which is to say debt and equity markets, as they are the state of the broad economy. And the third thing is that the broad economy is not in as good shape as they would have you believe. The broad economy is in great shape for an old, fat, bald, rich guy like me. Subsidized interest rates, very low interest rates, benefit people with access to credit and people with the education to use it. That is to say, guys like me. Is the government trying to subsidize guys like me? No. The truth is that the economy isn't working well for people in the bottom half of the demographic. Yes, there's a lot of jobs, and most people have to have 3 of them to make a living. For those people who vote, and they're going to be voting very quickly, the economy is not working well. And appealing to them, even by way of lies, is something that politicians have to do. What investors have to understand, separate and apart from the moral aspects of a rate cut, is
that more cash in the economy simultaneously increases the near-term rewards and enhances the long-term risks. What the Fed has decided is that inflation is less important than politics, and as you make credit more freely available to people like me, you stimulate animal spirits at the same time that you increase the depreciation in the purchasing power of the US dollar and the real return to savers after inflation. So, investors need to take both of these circumstances into account. Investors also need to take into account that while increases in liquidity and a decrease in the discount rate increase confidence and lower the near-term probability of a liquidity squeeze or market panic, it increases the impact of that in the longer term. So investors need to take into account the fact that this near-term party might carry with it a longer-term hangover. I'm not suggesting that you organize your whole life around panic and fear. I'm just suggesting that your listeners maintain enough liquidity so that if the party ends, some of that liquidity should be in gold, allowing them to benefit from the circumstances rather than being victimized by them. When I was actively employed at Sprott, running their brokerage operations, I made it a point every quarter to call 25 or 30 business owners, both public and private, and I would ask them, "How do you feel about the broad economy?" The response was, "Terrible." Then I'd ask, "How do you feel about the direction of the U.S. economy?" And they'd respond, "Terrible." Finally, I'd ask, "What's the outlook for your own business for the next 12 months?" And they'd respond, "Wonderful." I'd tell them, "You realize I'm having this conversation with 25 or 30 people, and the answer is always the same. The world's going to hell in a handbasket, but my company is doing great. And of course, collectively, these people are the economy, so they need to balance this nervousness by recognizing both the upsides and the downsides." Among the audiences we serve, they're very responsive to aggressive direct mail. That is to say, "The world's going to end on Thursday, and here's how you can profit." Now, in direct response to your question about talking to public company resource company CEOs, the response really depends on the nature of the companies. For very small companies like exploration companies that are out of favor, new cash is very difficult to come by. Conversely, for prospect generators who generate exploration ideas and sell them to major mining companies, the demand for high-quality exploration targets has never been better. Companies like Elemental Altus, EMX Royalty, and K92 Mining are seeing major mining companies seeking them out for exploration projects, which suggests that high-quality exploration is set to ramp up, and we'll likely see this reflected in the market over the next few years. Reflecting on our conference, we had Sean Boyd, the former CEO and now chairman of Agnico Eagle. He mentioned that Agnico Eagle is in a very positive phase. They've resolved operational challenges, the gold price is rising, and they have a robust pipeline of projects thanks to their long-term investments. This sort of bullishness is widespread among the best companies, not just the biggest. The market is showing rational behavior by beginning to distinguish between good, bad, and truly weak companies, which is a sign of a healthy market. I think we're headed into a bull market for precious metals, followed by a broader natural resources bull market. When we hit that, investors might behave as they did 15 years ago, but for now, capital allocation is improving. If we see a real market crash like in 2008, driven by a collapse in confidence and a removal of liquidity, everything typically goes down. The sell decision isn't made by individual investors, but by margin clerks looking to find buyers at any price. The 2008 crash saw even gold fall after holding up briefly. After such a crash, the most stable asset classes typically recover first, with gold historically being one of the earliest to rebound. People often turn to gold in times of fear as it's not a liability for anyone else. Additionally, major corporations with solid balance sheets and high liquidity also recovered quickly. Meanwhile, riskier assets like penny mining shares took much longer to bounce back. This is why I advise people to keep most of their natural resource investments in high-quality companies that offer liquidity, stability, and even dividends. This provides some downside protection. While it's essential to pursue big gains with speculative investments, these should be done with money you can afford to lose and only in companies where you're prepared to endure significant share price declines in the event of a downturn. Regarding cash on the sidelines, now might be a good time to hold more cash and less equity if you're willing to put in the work and are looking for opportunities. Personally, I hold more cash than typical, though that's partly because the current private placements and other investment opportunities aren't attractive enough for me to deploy all my cash. For most people, the return on cash, especially in a U.S. Treasury, might appear decent but likely fails to keep up with true inflation. Watch our other videos. Also like, subscribe, and share this video.